Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Sameer Kalra of Target Investing, Vineeta of Ventura Securities, and Vineeta Sharma of Narnolia Financial Advisors join me on the show. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss Sun TV, whether the rally will continue. Yesterday, the counter was up almost 10% in trade, post the strong set of numbers that came out. Whether the rally will continue or is that not going to happen? We'll ask our experts. Apart from it, we speak about Eicher Motors came out with numbers during market hours yesterday, but the press conference and the conference call was after the market hours. Apollo Hospitals, we asked our guests whether they're concerned with the entire issue of the pledge share increasing by another 5 percentage points. So now almost 80% of the promoter shareholding is pledged. The management has given their explanation, but that is something that we need to ask for. And we speak about the Vedanta Group stocks. Both Sterlite Tech and Vedanta Limited are under pressure. Is it the right time to start accumulating, or will that be an avoid? That's something that we will ask our guests. But the first counter that we want to talk about is Sun TV. Came out with strong set of numbers. The ad revenues, the movie revenues, the subscription revenues, all of them were strong in trade. Even if you're looking at it, the gap between Sun TV and now Z, because of the move that came in yesterday, and Z, how it's fallen, is actually narrowing significantly. So should Sun TV be the preferred choice if you want to play the media? That's something we'll ask our guests. So Vineeta, what did you make of the numbers? Is it worth accumulating Sun TV to play the media theme given the pressures that we've seen in Z?
So I think that the entire media space is up for disruption. Having said that, Sun is a very strong franchise. It will do well. It has been doing well in all the segments, and they have a really strong hold on the South Indian diaspora. So they will do well, but I think there is going to be limited upside because, primarily the revenue disruption is going to be very high from three segments. One is the individual channels that you can subscribe. So all these channels all these broadcasters are going in for packs. If you do the individual channels, I think there's going to be loss of revenue. Second is the fact that once the eyeballs are cleared, how many get per channel, the advertising revenues are going to dip. And the third is the fact that the disruption is at an individual level goes deep into the hinterland. So nothing stops you from downloading an app and watching the OTT platforms on your mobile. So I think there's huge disruption. The game in the media space was that OTT would be done by the big boys and we will do domestic. And if you notice, the programming had also become entirely Bharat from being urban of these channels. So I think that is going to get disrupted. And I think that it's mostly a trading play where you play positive news and you get out as quickly as possible.
Okay, so but overall, this would mean that you would have caution on the entire media space.
Absolutely, not radio. Mostly on the
not even print, maybe probably print newspapers or something like that.
Print is losing relevance completely. What is going to happen is advertising is getting very, very digital, and it is eventually going to move away from TV advertising, and it's going to get more analytical based. So it's going to get more digital. So TV, which is mass, is going to go away. Print will get hit the most. So we've seen what happened with print media in the last quarter with HT media. Little bit of revenue pressure, cost pressures on the print side of it, the newsprint side of it. Margins fall substantially. Advertising revenue goes away. Soft environment doesn't come back, and that goes more digital then. So digital is the theme, and the media as an entire pack, barring for radio, will get hit.
Okay, Vineeta, you agree to points. What did you make of Sun TV numbers, and then you agreeing to the points that there will be more disruption that will come in this space?
So surely the business models of all these media companies, they are undergoing a change with the technology move that is happening. But all in all, if we look at Sun Pharma and Sun TV and be closer to what the numbers have come, the numbers have been pretty good, and management is also guiding for 20% growth in ad revenue as well as subscription revenue. Digitization is going to get completed in Tamil Nadu by June 19. Also, on the revenue front, both the ad revenue and subscription revenue should go up, but there will be hangovers on the margins because of content costs that will go up. as well as on the other, all kind of costs, I would say, are expected to go up, and that will be a pressure on the margins going forward. Because Sun Next also, that they are launching the company saying that they'll have a completely new team which will, and this is not that easy. Saying that is not that easy to get it implemented, having a new team all together and getting it implemented. So that should be a hangover. Looking at the valuations as well as the fundamentals, the financials, how they are paying out, definitely it's trading at the historical lows. I think somebody who wants to stay in media, you have very limited space. So with all that happened with Zee, so I think Sun TV, one can accumulate.
You think money will build because of what happened in Zee and the challenges that people know that the promoters want to get out? There is just one play in the TV media that you need to bet on, and the valuation gap will get lower and money will flow from Zee to Sun if someone wants to play the media theme.
Yeah, because the media is one theme. I think it's undergoing a change, but it is a theme for tomorrow, I would say. Because definitely, and there are already the players who are there since so long, and they have a brand franchising. They have an upper hand into changing the way and getting into the right strategy.
Okay, Samir, what's your view on Sun TV and the entire scenario?
So I think the media space is going to go through uncertain phase for next 6 months.
Okay.
Because of the norms which Vineeta has explained. I think over there, what will happen is first my monthly bills as a consumer goes up, right? So then my choices of actually going specific will come more often. So I'll have monthly variations on what I want to watch, what I don't want to watch. Over there, these people will, this media companies, especially televised ones, will have a lot of disruption and giving a certainty of revenue through the subscription and the advertising, which they get right now, it will be not there.
Okay.
So that risk kicks in. So there will be a certain amount of discount on the valuations what they were trading at. So I think that is the first. Second is Sun TV, if you see, is more politically influenced as well. So as the election comes up, there will be a certain political movements in the stock prices as well. That happens generally. So I think it's better to stay away for 6 months, let the situation settle out and then relocate it.
Okay, that's the view that's coming in on Sun TV and the media space. Let's move on to the second stock, and that stock that we're talking about is Eicher Motors. Now, numbers were pretty much in line, no major fireworks that came in, and the counter did actually, in fact, manage to fall in trade yesterday. Today, it's managed to rebound, but no fireworks as such in Eicher Motors. What do you make of the numbers, or what do you make of the management commentary? It's down almost 25% in the last 12 months and 32% in the last 9 months. Vineeta, what's your view on Eicher Motors? Post the numbers. What have you all told your clients?
So overall auto space, we have been neutral, like last time also when we talked. So in the entire auto space, we are seeing sluggishness in the volumes, and that view holds. Within the auto space, definitely Eicher Motor is one pick, which somebody wants to accumulate at this point. I would say there is no harm into it. Okay. But definitely in a short term basis, I'm not very convinced with what's happening around. So top line, I'm not seeing too much of a growth. So 3.5%, 4% growth. Margins have deteriorated because of the launch cost of the twins that they have launched. Also going forward, also management has shown some kind of so sequentially maybe the EBITDA margins move up, but on a year-on-year or for going forward from a 1 year's point of view, margins are bound to stay low because of the extra cost that they will have, as well as commodity prices uncertainty. On the VECV segment also, volumes have grown 6% odd, and there also margins have taken a dip, and management has, for FY19, though it's almost done, so they have lowered the production guidance. So that itself shows the kind of sluggishness it would go through. But overall, all in all, I would not say it's stock is bad or something. Yeah, if somebody wants to accumulate for a long term, it can be a buy.
Okay, then what among the 4 two-wheelers What's the pecking order that you've told your clients? Which is the best, which is in avoid?
So we're liking Bajaj Auto and Eicher Motor. Bajaj Auto because now they have a strategy. They, they already they are into gaining the market share, and the volumes are showing. So definitely margins. There is a room wherein they can allow some kind of a margin dent for the company. But then I think if you look at the dividend payout and the dividend yield, also on the kind of cash flow the kind of company generates. So Bajaj Auto is the first order, and then Eicher Motor.
Okay, what do you make it? You're getting Eicher 33% cheaper than almost 9 months ago. Is it still expensive, or do you think there could be more correction?
I believe there would be a correction. I think it's 25 times 2 years out.
Okay.
Two is that out of every 14 bikes sold, only one is the 500cc. So the bulk of the competition that is being launched by Triumph, or you talk of Bajaj and Java, which has come in, is in the 350cc. So that 350 is going to see volume correction for Eicher in terms of market share losses. If they will do well, if they can even maintain static growth. So if they maintain a static growth with the single digits, the P is going to come off. And 25 times compared to the other people is very on the higher side. Having said that, I believe that with if you're expecting low inflation to play out, the financialization can kick in again. So loan growth will grow, all that will happen. So the industry side of it will get better, but I think Eicher will have a tough time over the next couple of years.
Okay, and what about the other play also? Because we've seen that the numbers that have come out both on the quarterly earnings as well as the monthly sales number for the four-wheelers, for the two-wheelers, it's just been very bad for the auto space. So you believe that this trend will continue over the next few months?
So again, let's talk two-wheelers. As we spoke last time, we remain underperformer because Bajaj is out to get volume. It's a question of survival for Bajaj. So they want to have growth. They're facing too much competition in the current segments. So they're targeting the executive segment where Hero Honda is a majority share, which is about 67%. So Bajaj is expanding there. It's going to hurt Bajaj. It's going to hurt Hero Honda. So the volume growth, it depends on how the volumes play out. And I believe that Bajaj is slowly losing steam despite the price cuts in that segment. So there is tough to call a play. I like TVS per se because in spite of all these pressures, they have really grown well. But the valuation out there is not that comforting given the slowdown generally that we are seeing. But given a choice, if the prices were to come off in TVS, I would be a buyer out there.
Okay, TVS would be your top pick.
Yeah.
Okay, what about you, Samir? What did you make of Eicher's numbers and the commentary?
So if you see the numbers, dealerships have increased by 98 dealers this year. So I think that is a positive. The volume is facing a capacity constraint. So that is the second part. The price hikes which they have taken impacted the volume takeoff also. And because Eicher is a more large ticket two-wheeler, so financing is 75% of the sales. So that is impacting the other retail sales part of it. And if you see the truck segment, they are losing market share in the middle and light vehicles and gaining market shares in heavy duty. Because heavy duty is now gaining more sales than light and medium because higher axle capacities are being used by the operators. So over there, as whole, the numbers were neutral for us. They were not too negative or too positive. But I think next 6 months will be a little tough for autos throughout, whether it's two-wheeler, four-wheeler.
What did you make of the commentary of Eicher Motors?
So they themselves are a little on the watch of the retail sales because their expansion of the dealership network has hit their outlook as well. Because what happens when you're trying to push off the wholesales, there's a dealer inventory built up. And in January, the highest built up was in two-wheeler segment. So I think for that, there is a burden, and then the ABS norms will not hit them that much. But the dealer inventory is still there. So there are a lot of bikes at the dealer inventory, which is non-ABS. So that has to go on a super discount to be pushed before the norms kick in, which is April 2019. So I think this all will create an issue for next 6 months for Eicher or any other two-wheeler.
So are you buying any of the two-wheelers for you or your clients?
No, we've put the auto on hold as of now. We've liquidated certain positions.
Even Maruti, because you were quite bullish on Maruti.
December we reduced the weights on all autos.
The theory didn't pretty much work out for Maruti?
No, because the registration numbers had a steep fall, and then we saw the production cuts, what has happened. Even that continued in January as of now also. So I think till the time the whole inventory situation doesn't solve out, which will be only sorted out when the registration really picks up.
Okay.
So I think this chain will be making it much more slow for the numbers.
Okay, so that's the view that's coming in on Eicher Motors. I don't think anyone's too gung-ho on the two-wheeler space at this point of time. The next stock is Apollo Hospital. The numbers were decent. I think what spooked the market yesterday was the issue of pledge share, and today after opening up almost a 6%, Apollo Hospitals has corrected from that level and it's down in trade. So there is anything to do with pledge. Now what happened was they had a pledge of 74%. The management said that in January, because of the unwinding of the KKR instrument in which they had to repay them, so they had to raise additional money by actually pledging more shares. That means the pledge now is close to 80%. So the 74.8% was the December end. As of Jan, currently it's almost close to 80%, and that's what the management said. 5% additional pledge was created. So that's anything to do with pledge these days is not considered positive, and the counters actually see a sell-off. But we ask, is this a big issue for Apollo Hospitals? Will they be able to get out of this, or should investors be concerned? Samir, would you be concerned in Apollo Hospital? Operation wise, everything, they came out with a decent set of numbers, but I think the market is scared with this pledge issue.
I think for us, Apollo was always a void. Even at the valuations, at the run-up, we avoided it because of the pledge only, and that pledge has come to now 81% specifically till Feb, and that pledge money has gone somewhere. The that capital has burned. Now how do they manage to reduce that by 50% in next 6 months is a wonder to me. As in, if you're already 81% of your holding is pledged, how will you revoke it? You need that much of cash. That can either come through a sale of that percentage, or at a promoter level you have to raise it somehow by selling off Apollo Munich or something. And even if you see fundamentally, the net debt has risen from 2600 in March to 2750 in September. That 150 crores is purely on the working capital side. So the receivables have gone up from 800 crore to 920 crores. So there the working capital is also getting stressed. It's not only the pledge which is the worrisome. I think for us the balance sheet is also a worry. So I think it's a void for us.
But they've said that they will sell Apollo Munich, and they will sell their stake in Apollo Munich. There's one more asset that they have, they did not disclose. They say that they will sell it and they will be able to get it out, and it's not such a large pledge that they will not be able to manage. The ratios don't turn dramatically because of this.
But see, if you see, they hold around 34% if I'm not wrong, right?
Yeah.
And that 80% is already pledged. That means around 25%, 26% of the company is pledged out. Now if the prices go down from here, another 10 to 20%. So there is always a LTV of these pledges on a certain price. If they have pledged at 1300, that might get triggered at 1000 below. So they won't have a control over there to negotiate. So you might have this situation coming up sooner than the Apollo Munich getting sold. So I think there's more risk on the downside in the near term, and it's better to avoid or exit as of now.
Vineeta, you agree to the points that he's made that pledge share, according to him, is a concern. What's your view?
So it's not in my active coverage though, but whatever I could understand from Apollo, and I've been seeing the company since a long period of time. So this pledge, it's not created in last 1 year, 2 years. The pledge has been since 2009, and company has sailed through bad phases. 2013 also, the pledge came down, and then again. So the pledge has increased definitely to an elevated level, which is a cause of concern for any investor. But if you look at the fundamentals, so 250 to 350 crore of yearly profit since 2009, and the cash flow from operation has been good, and they surely the debt is at elevated level, but that has debt is not a problem for a company. It's required for growth, right? And the debt is around it's less than 1:1 ratio, which I think is that not that big a problem for any company. So, given that the management, what they are talking about, that they will sell stake in Munich and then be able to get the release share pledge release in next 6 months, I am hopeful that it should get done, and I am not that concerned for Apollo Hospital as such, that even the fundamentals have been for year after year, there has been a consistency in the fundamentals, and operation wise also, even working capital is required and it has gone up, but if you look, it's only 10% of the total sales. So it's very much in control. So I don't see too much of a risk in Apollo Hospital though, but that's my view. I would, however, we are neutral on the stock, so not been tracking too much of it.
Okay.
That's the view.
Okay, what about you, Vineet? What should one do if they are holding Apollo Hospital or they want to enter? You're getting it 10% cheaper.
So the market has taken a solemn pledge not to buy pledge shares. Okay, given that kind of situation, you're skating on thin ice. Okay, actually what has happened is the skeletons are tumbling out of the cupboards. Basically, you saw Imami, which looked like an unlevered company, but actually the levering is done at the promoter level. So same way, you have a very high gestation period business, 10% ROE. Hospitals is a very heavy capex, high gestation period business. You have ROEs which are barely about double digit. You have 33% stake, 83% pledged, and if the price falls, that it could get triggered. So it's very difficult. I think I would stay away from this stock.
Okay, and apart from it, what did you make of the core numbers as such?
Numbers
is it no? So in there now, initially there were just 2 hospitals. Now there are a bunch of hospitals that have come out that have been listed. Is Apollo the best play, or should is this a hospital space is something that you would avoid?
See, as I told you, it's a very long gestation period business, number one. Number two is the fact that all big tech are all going very heavy investment in disrupting this space. Okay, also you have cost of healthcare, which is going up. Today is $32,000 per day. So there's a limit to what you can really do. And these hospitals have become very doctor centric. So when the doctors leave away, things get disrupted. But that risk is not there with Apollo. It's a pan-India player. It's got a brand. So I think the business will persist. We have a very large population. But given the fundamentals of this stock, I think
you would stay away.
Yeah.
Okay, that's the view that's coming in on Apollo Hospitals, and the final stock that we want to discuss is basically the Vedanta Group stocks, which have been falling significantly, Sterlite Tech and Vedanta. So I'll start with you only. Vineet, you were very positive on Sterlite Tech. Then this entire corporate governance issues with terms of what they did with Kane and Anglo American came in, and Sterlite Tech also cracked significantly. Is that a matter of concern? Is your view still positive on Sterlite Tech?
So, like Apollo business looks strong, in the similar fashion, Sterlite is in a very strong wicket as far as business is concerned, because they are in the right space, which is a compulsory rollout for the next decade, right? So you need fiber to run driverless cars, and that's the new generation technology which is coming in. Post fiber, they are managing the networks. They're getting into the software virtualization part, and there is a huge part of software technology also which is being unbundled. So that's a 75 billion opportunity. I think they are growing well. They're end-to-end capitalized, end-to-end. They have a presence. They have the highest margins. There's shortage of fiber globally. So I think they will do well. But the pledge, as I said, is anybody's guess. Having said that, they have been pledged 90+% for a very long period of time. And to me, that is not a concern.
Okay, not a concern. So you still remain bullish on Sterlite Tech. What about you, Samir? Any of the Vedanta Group stocks that you would accumulate?
I would avoid right now because if you see the books, see the pledge is at promoter level. It's not the company. So I'm really not denying that there is no scope in Sterlite Tech in the future in it. But if you see the whole system, it's the pricing power on the products which they have is not there because it's more of B2B fashion. And the order book is there, so that picks up the execution and the volume pace. If there is a slowdown on the execution part because of certain customers getting into that debt trouble, or another financing slowdown kicks in over there as well. So I think this will hurt Sterlite Tech as well on the fundamental side.
Okay.
On the other side, Vedanta, on a fundamentally basis, we never liked it because of the cash burn which it was doing at a point where they need the cash for future capex, which they have announced for next 3 years. So I think these irrespective of the corporate governance issue, which was always overhang. So I think these issues don't give the pricing power to these companies, and we really don't want to be there.
Okay, what about you, Vineeta?
So we are neutral on both the stocks, and one is the main corporate governance issue. It's not today; it's been there always. So considering the Kane merger and everything, so I'm not very comfortable with the way management treats the businesses. Secondly, if we look at the financials coming to VEDL. So Hinzing did very good, but international part, Gamsberg, which is in South Africa, that mine is going very slow. So that is, I think, it should have been up about 70%, and management is guiding only about 20% by the end of this year. Then comes your iron ore, which is not doing very good because of the Goa ban. Then copper smelter, that is not started. Coming to your steel, that electro steel business, that is okay, but it's a very small portion of the company's business. And then aluminium, that is also the management has given lowered the guidance of the volume. Prices on the premium is lower, so you're not very comfortable with what the PAT would emerge out of aluminium business. And then the oil and gas, there also the volume has been curtailed by the management in this con call. So overall, if you look at the financial side, we're not very comfortable with VDL's financial, and owing to the volatility in the prices, all non-ferrous prices as well as crude. And considering Sterlite Tech also, so I don't have a very clear view on Sterlite Tech, but whatever little I could understand regarding the China, because they have some 40% export, and China mobile company is a big growth virtue, and there also so the tender comes out in third quarter, and that has not come out, so that is also overhang on how the volumes and top line would go for Sterlite Tech. So I would say avoid for both the companies.
Okay, so that's the view that's coming in on the Vedanta Group stock. Vineet, however, stays positive on Sterlite Tech. We've completely run out of time. With that, it's a wrap on today's edition of Hot Money. Many thanks to all of my guests, Vineeta, as well as me. Thank you so much for coming in. Ask BQ comes up next, 8 into Bloomberg Quint.